Hi folks, I thought I'd throw together a video to give you my 2021 predictions or opinions about what might happen and where the opportunities might lie for this year. There's a heck of a lot of noise out there at the moment from the media, and I'm sure you're getting it from all angles, from your networks as well, about what's going to happen in the property market, this pandemic, when is it going to end, all of that that's going on. And so I thought I'd just jump on here, give some perspective so that we can, with a clear mind, make some sensible business investment decisions for the year ahead. So the first thing I want to talk about is, of course, what I see in terms of an opportunity right now is the availability of money. Money is normally the thing that people are most concerned about getting their hands on when it comes to investing, but this year I really see that as not being an issue as it's been in the past for people starting out. So what do I mean about availability of money? So we have interest rates at an all-time low, and the banks are even making noises about those interest rates going lower to potentially negative levels, which would be a first time in history, which would be incredible. So what that means is for the Joe public out there who might have 5, 10, 15,000 pounds in the bank, they are going to be faced with the prospect of paying a bank to look after their money for them. So in terms of the availability of private money, I think you might see people who were maybe close to the idea of being an angel investor or a private money lender, maybe more open to that idea. And you don't even need to pay them or offer them the kind of returns that you might have needed to a couple of years ago. So there was a time where people were offering, 10 to 12% per annum return on private money. And now I certainly saw 2020 and coming into this year, looking at offering private investors anything north of 5% as a good deal for them. So in terms of private money, I think we're going to see an abundance of that come to the marketplace and at a cheaper rate, which is a good thing. And then let's talk about institutional money. So we have seen the government give financial support at the drop of a hat. So here's a bounce back loan, here's some furlough scheme. They are effectively just pressing a button and just getting money out into the marketplace to stave off any kind of deflation and make sure that people are spending money in the economy. So what does that mean? Well, for us as investors and borrowers, what I see is quantitative easing, which is like music to my ears, is the devaluation of the currency, which means if you have debt aligned with an asset, like a property, for example, then as inflation hits, which it will inevitably after quantitative easing, property values will increase, but the perceived value of that debt looks to decrease. But in real terms, it's the buying power of the currency that is decreasing because there's more money in the monetary system. So I think you'll see institutional money being more readily available, probably after the pandemic just calms down a little bit, round about summertime potentially, but that is a guess. And so the good news is that I think money will be more readily available as well as cheaper. Okay, so let's talk more about the market in general and specific strategies within the property market. Let's look at commercial property initially. And we have seen a massive impact to the retail sector due to the pandemic, which means that you'll see empty retail units on the market, which could lead to opportunities. What could you do with these empty retail units? Well, with permitted development planning changing and constantly changing, and the talk of it changing and relaxing even more, you could see the potential to change and convert a commercial unit into residential, offering you an uplift in added value there. So that's one opportunity. What we've also seen is the boom of e-commerce in this pandemic. So small e-commerce businesses that have just sprung out of nowhere suddenly now need space to store their goods. So thinking of warehouses or industrial space that under normal circumstances would be in quite a competitive market, you'll see that now people are going to be looking for space for their e-commerce business. So I'm in negotiations right now on a warehouse with land to build another warehouse beside it, to then split up an asset, strip that into smaller, more affordable units to rent out to these small e-commerce businesses, as well as you've heard of dark kitchens that are on good transport links on the outskirts of cities, maybe between cities, so that any goods can be easily transported between those hubs. So look at warehousing and industrial space for asset stripping and leasing out to e-commerce or dark kitchens, just as two examples. There's many, many, many other options as well. And let's talk about residential property. So we've seen since lockdown number one, the tap has effectively just been turned on again, and this pent up demand in the property market has really shot prices up. And in 2020, we saw property prices increase by 7.5%. The talk is on the street that, of course, there's going to be a property crash. Now, nobody knows if and when a property crash, and what would you class as a property crash, is going to happen. So what I predicted is if stamp duty holidays stay as they are, ending around about March time, and the furlough scheme around about the same time, then the market not crashing necessarily, but certainly cooling off. So from growth of 7.5% in a year, which is very, very healthy and positive, to actually not growing at the same rate. That doesn't deem a crash, it just means a cooling off of the market. But where is the demand going to be? Well, I believe that in single lets, that is going to continue to be strong. People who may have sold their properties to release capital if they have lost their jobs or been made redundant are now into that rental market space. Or people who have bought a larger dwelling out on the outskirts of a city because they found that working from home really suits them well. But when the offices start opening up again in the maybe Q3 of this year, they're going to maybe potentially need to rent closer to work during the week. So, but single lets as well as HMOs, I believe will still continue to have strong demand on the rental side, which means that rent will increase, void periods should decrease, leaving you with a nice healthy cash flow in your business. Obviously on the HMO side, it will depend on the demographic that you're renting out to and the location that it is based in. Next on my list, serviced accommodation. Okay, so that strategy has been hit pretty hard, hasn't it? The staycation kind of started and stopped. There's no tourism going on, where you might have got short-term lets from contract workers or blue-collar workers. That hasn't been happening in the same pace that it would have done in previous years. So if you have a diverse portfolio and serviced accommodations happens to be one or two of your units, then you probably won't have felt that too much. But if it's a large chunk of your portfolio, then you might want to look at maybe switching some of your exit strategies on those properties just to give you a more solid base to your portfolio, just to help things calm down. So talking from experience, I opened a hotel right in the middle of this pandemic. I recognize that the revenue that hotel generated in 2020 is not conducive of what it's going to be in the future. And even here in 2021, I assume, and this is just a personal prediction for me and this hotel, is that I'm unlikely to see it perform in the first half of this year. So look, in terms of, is that going to affect my business? Because I have a diverse portfolio in a number of other different locations and strategies, that is in itself not catastrophic to the business. Okay, so serviced accommodation, I believe, will towards the tail end of this year really come back into its own when the staycation in the world starts to open up again. So optimistic, but some pain to still go through. Property prices, here we go. So the $1 million question, are property prices going to go up, down, stay the same? When is this crash, if there's going to be a crash, actually going to happen? Well, no one can predict it, as I've said, and it is just opinion from many people. In fact, if you look hard enough, you'll find a report that says that properties didn't perform particularly well last year, and then you'll look at other reports that say, yes, it performed well. And there's many property experts out there that share massively different opinions on what this year is going to bring. So the key lessons, I guess, to surviving in the property market here in 2021, according to little old me, who's been in the game for 20 odd years and got the grey hairs to show it, is look, keep your head, carry on doing exactly what you know works, right? So I'm continuing to buy right now. We're going through conveyancing on purchases right now, even though everyone is shouting about a crash. If you structure your deal in a way where you're making your money when you buy, then any shift in the market should not affect your business. So I'm continuing to buy. I know that all of our team and our network are continuing to buy. You may adjust your strategy accordingly. Things to keep your eyes on is just the time frame in which transactions are taking to go through. So a conveyancing that would normally take 6 to 8 weeks is taking longer than that. And we have got lenders who are maybe a little jittery in terms of lending on property at the moment. But lending is still happening. So my message is very much keep calm, carry on, make sure that you know where your exit point is in your deal, structure it correctly so that you make your money when you buy, and ask for advice if you're going into uncharted territory. Don't listen to the noise, just keep focused on what you know works and have fun with it. I hope that's helped. Take care.